to session number 8 in the CISI Level 2 Fundamentals of Financial Services qualification. This session is going to complete the Chapter 3 on banking, and we are going to be looking at the role of investment banks and central banks during this session. I just want to introduce 2 people that you have seen previously in other sessions. We have Monica from Goldman Sachs. We also have Tutu from Legal and General Investment Management, and we will be joined at some point by Arnold Fomété, who also used to work for Goldman Sachs but now works for Wellington Management. So thank you very much for joining us for another session, ladies, and we'll welcome Arnie when he arrives. So this session builds upon what we've spoken about already in terms of retail banks, and we just to recap, we've looked at what retail banks do, the fact that they offer financial services to the general public, primarily focused on lending via credit cards, mortgages, and all of those what we call retail financial products. We just need to conclude this now by looking at the role of 2 other types of banks, primarily investment banks and central banks. So really, we're just going to understand the roles that they play within the financial services profession and also the kind of economic landscape as well, especially when it comes to central banks. So there were some activities that you were asked to do prior to the session, and that primarily was to have a look at a couple of video clips on YouTube. One of them was actually a recruitment video for Goldman Sachs, who Monica works for, and who Arnie, who will join us, used to work for as well. And I asked you to look at or establish who the clients, the predominant clients or customers were of that bank, and what areas did they offer advice to those clients on. So what I'm going to do is go to our two professionals, and it might be good to come to Monica first, as you work for Goldman Sachs. Would you like to tell us a bit about Goldman Sachs and generally investment banks, who you kind of work with, and what the organisations do?
Yeah, sure. So Goldman Sachs, so I work on the investment management side, which isn't on the investment banking side, but I can speak about sort of on what the investment banking does, and I'll also maybe differentiate between investment management. Investment banking is basically, we're a global investment bank. We provide all sorts of advice to global clients, primarily institutional or corporate clients. So the likes of sort of high street retailers that you would know, or even banks that you would know, just general corporations that you would work with on a day-to-day basis. And the banks provide advice, strategic advice on how to grow their company, and thinking through their finances, whether that be if they need money to grow their business. The bank can help by raising either equity or debt through that. If a company is thinking about selling themselves to a bigger company, the bank can help arrange for that as well through mergers and acquisitions. And general sort of sell side strategic advice. They will be there through that journey with that bank. And I work on the investment management side, which is the buy side of the firm, which is separate to that. So just wanted to make that distinction.
Thanks, Monica. So in terms of the clients predominantly that Goldman Sachs works with on an investment banking basis, we're talking about private limited companies that maybe want to go public. Is that and also
yes, absolutely,
PLCs?
That's right. So private companies who want to go public and be listed in the exchanges, Goldman Sachs will help with that IPO as well.
Great, thank you. Excellent. And Tutu, what do you ever get involved with working with investment banks in what you do at all?
Well, yes, but not the investment bank area that Monica has just described so very well. We will interact with investment banks such as Goldman Sachs because they'll provide certain services to us. So we are on the buy side of Monica's sell side over in Goldman Sachs, but it would be in the investment management side. So no, not on the investment bank side of things.
But on the asset or the investment management side predominantly.
Absolutely, yes. Yeah.
And Monica, on the investment management side that you work on for Goldman Sachs, obviously, as we said, that's very different from the investment banking side of what Goldman Sachs does. Who do you manage investments on behalf of?
Yes, so we manage investments on behalf of, I would group them in three different categories. One is pension schemes. So any company will set up a pension scheme for their employees, and Goldman Sachs will manage that pension money by investing in various stocks and bonds, and also for insurance companies, because insurance companies also need their assets to be managed as well, in order to meet their liabilities. And also other big institutions such as sovereign wealth funds and central banks. Also, they have large pools of money that needs to be invested, and Goldman Sachs will help with that as well.
Great, thank you. And just as you were talking there, Monica, Arnie has joined us. Welcome, Arnie. We're just talking about investment banks and generally. Hi, Arnie. Just what investment banks do generally, and Monica and Tutu have made that distinction about the fact that, as Monica was saying, she works on the investment management side, and Tutu was saying that she works with Goldman Sachs on the investment management side. But you have this with Goldman Sachs, you have this distinct difference between the investment management element and the investment banking side of the business. So we were just discussing how they differ, and for the purposes of the qualification here, we were talking about what the investment banking side of what Goldman Sachs does actually is. So we're just kind of making that distinction as we go through. I just wondered, actually, from the point of view of Goldman Sachs, whether you might know this from an investment banking perspective. We spoke about, obviously, they advise corporate clients, whether they are private limited companies looking to go public and list, or PLCs, big corporates that maybe want to raise additional money through bond issues, so issuing debt, and also make potentially even things like rights issues where they want to issue more shares to shareholders. Do Goldman Sachs provide any advice to governments about raising money through bond issues? Do you know?
That is a good question. I know from an asset management perspective, we do work with governments in the sense of their central banks and sovereign wealth funds, which are through government entities. But in terms of raising money directly for the government, I don't believe that is the case.
No, actually, when we come to the central bank element of this, and the reason I asked that is because obviously the government has the debt management office, which looks after the kind of the process of that. I just didn't know whether Goldman Sachs ever provided advice to the government. No, obviously not from an kind of executing that, but actually whether they advised them about the structure of maybe a bond issue or something like that. But no, that's fine. That's perfect. Thank you. Thanks very much. So we've had some really good explanations there from Monica and Tutu about what investment banks do from the investment banking side, and distinguishing that from the asset management or investment management side of things. So just to kind of summarize that and consolidate some of those key points that were made there. So you can see with this slide on the left-hand side, you've got some of the larger investment banking kind of logos up there, and we can see Goldman Sachs, who Monica works for and Arnie used to work for, and who Tutu has some interaction with. You can see Goldman Sachs down there. Some of the others, you've got JP Morgan, well known, Morgan Stanley. There are a number, and I think I'm right in saying that there were a few more big investment banks around, but the financial crisis saw quite a few merge, and there were fewer bigger players in investment banking. And one of those, actually, if we look, we've got Bank of America Merrill Lynch, which was Merrill Lynch as the investment bank and Bank of America merging there. So there were quite a lot of examples, as far as I can remember, of investment banks merging together or being taken over to create less of them in financial services. So as Monica and Tutu were talking about, the main, from the investment banking side, the main activity is really providing advice to corporates, to businesses, whether they are private limited companies looking to go public to raise money and grow, or public limited companies, listed companies that are looking to borrow money through issuing bonds. And we've spoken previously about the distinction between businesses raising money through issuing shares or equity, and also the issue of debt or the issue of bonds. Okay, so investment banks often provide advice to these companies about how they may raise money via one or both of those methods. The other thing, as Monica spoke about, was about kind of strategic advice around things like mergers and acquisitions. So we're talking there about two large companies, PLCs, merging together and becoming one larger company. And in terms of acquisitions, we're talking about when one company wants to take over another and acquire it. So when we spoke about saving and borrowing in earlier sessions, we had an example about Apple taking over Beats and things like that. So the investment banks can provide advice about the structure of that deal, how that works, how shares may get transferred and the value of those. And again, also Monica spoke about IPOs or initial public offerings, which we'll look at later on. And investment banks can make all of that happen for their corporate clients by advising them about the share price that they might start selling at. They even, and you can probably confirm this for me, Monica, Arnie, Tutu, but I believe they even kind of go out and find initial buyers in terms of institutional investors to buy some of those initial shares when they're offered to the public. Is that correct?
Yeah.
Yes.
Okay, great stuff.
So on the buy side, a company like Legal & General would be on the other side of that transaction.
So Legal & General would be buying those shares, would they?
Yeah, and you'd have the whole mechanism for allocating those initial shares to the different funds, and yeah.
Okay, excellent, fantastic. So the likes of Legal & General that Tutu worked for will be, we call those pension funds, and Monica was mentioning these before, pension funds, insurance companies. They're kind of referred to as institutional investors, very large buyers of shares, and that's what we call those. So as Tutu said, ultimately what happens is that when those shares are first issued by a company looking to go public, a lot of those are initially bought by these institutional investors, these investment management firms and the like. So, and then they're managed and they're put in the portfolios of funds for those companies that are managing those. Okay, so from the point of view of an investment bank, really the one of the core activities is about providing this advice to corporations. And as we said, to kind of consolidate that and bring that together, first of all, you've kind of got this capital raising role where they can advise businesses about how they raise capital or raise money. So in terms of investment banks, we are looking at large scale capital raising. So anything from around $5 million up to around $100 billion or pounds. So it can be very, very large scale, large amounts of money that investment banks are advising about how that money is raised through share issues or the issue of debt or borrowing money through bonds. So they provide advice around that, and they can make the whole process happen and take place. So that's the kind of one of the key functions of an investment bank. And as we also said, there's this kind of strategy support around mergers and acquisitions. So if companies are looking to take over another company or merge with another company, then the investment bank can provide advice and support around that. And so really it's almost on a consultancy basis and providing those services for businesses or companies that want to grow and advising them about the strategies they use to be able to do that and making that happen for them. Is there anything that Arnie, Monica, Tutu, anything that you would like to add to that we haven't spoken about there?
Not from me, no.
No,
all good, thanks.
Okay, excellent. There is a Monica and Tutu have spoken about the investment management side of investment banks as well, which can be something that takes place. There is one other thing that sometimes we hear about, and that's what's known as proprietary trading. So some investment banks have traders that work for them that buy and sell financial instruments, whether that's shares, bonds, in some cases derivative contracts, commodities, that kind of thing. And they have traders that work on their behalf to do that. They trade on behalf of the bank to make money for that institution. Have any of you come across proprietary traders in your time working for the organisations that you do?
We don't have it.
No.
So I think Goldman Sachs used to have a very large prop trading desk, but I think after the global financial crisis, it actually has been sort of regulated a lot more heavily. What I would say is that we still do have proprietary investment, so longer term investing on behalf of the bank's balance sheet. But in terms of prop trading, I think that has been sort of limited now.
Sure. Thank you.
I'd say we have a similar thing in the group, Legal and General, where we do have our own longer term investments, but that's managed in a separate company to Belgium. It's managed within Legal and General Capital, so completely separate, and like Monica's example, very long term investments.
Yeah. So much less emphasis, as there was. I'm going to show an example in a minute of somebody, but much less emphasis on the short term gains, more about the long term. Yeah, which goes again. Goes very nicely with the whole idea about acting ethically and with integrity, and making things about the longer term rather than short term quick gains. And we're going to say on that, that often this sort of trading is high risk, taking risky positions in trades to make money. I mean, we've heard a lot about GameStop over the last couple of weeks, and the battle between groups of investors and hedge funds, and how that has panned out, and the bubbles created during those incidents. So yeah, this can be high risk, and we have historically some examples of individuals, and I'll put up there this particular guy who I'm old enough to remember, Nick Leeson.
Yes.
So this is someone that got into a lot of trouble in 1995 when he was trading on behalf of Barings Bank, and ended up with making huge losses on behalf of the bank, and leading to the collapse of it. And actually on the classroom, I've put a couple of videos about Nick Leeson. And the thing is now, it's a bit like Jordan Belfort. He goes around doing interviews and writing books about his experience, kind of glorifying, in some respects, some of the activity. But this comes back to what Tutu and Monica were saying about regulation. And back in 1995, it turned out that the reason Nick Leeson was able to do what he did was because he had responsibility of checking his own trades. So there wasn't an independent individual or somebody looking at what he was doing. He was actually able to kind of sign things off on his own activity. So he was able to do whatever he wanted. And that's what led to some of the issues that caused the collapse of Barings Bank. So there's some videos on the classroom where Nick Leeson is interviewed about what it was like to work as a trader in the 90s, and some of the quite worrying things and eyebrow-raising things that he used to get up to. And as Tutu and Monica have said, that times have changed a lot now. and this is something that obviously we don't want to encourage. Sorry, Tutu.
I was just going to add, so two things. One, with proprietary trading, that it's quite difficult sometimes to manage that conflict of interest, because what's good for your own trade isn't necessarily what's good for your client's trade. So from that point of view, it needed to be more heavily regulated. The second point I wanted to make was that operational risk, which is what I've specialized in over the years, is something that really grew out of this Nick Leeson affair, because back then, when you could have a trader who was responsible for managing his own positions, and he could therefore cover his losses. Now you would have much stronger segregation of duty. So you'd have the traders who would do their job, and then you'd have the back office who would settle, and then you'd have other areas who would be checking that he was within the risk parameters that the bank had set. So something like this, not to say it could never happen, but it would be a lot more difficult now because of things that were put in place following this collapse.
Thanks, Tutu. Yeah, some really good points. Actually, that links really nicely into when we start talking about central banks and the tighter regulatory landscape that we see in financial services now. Yeah, thank you. Arnie, Monica, anything that you wanted to add there, or we've covered that? You think we've covered that off?
Yeah, I think so. And at Goldman, it is also there are strong walls put in place in terms of compliance and making sure that those activities are completely separate, so that the client's interest is not mixed up with the firm's own balance sheet interests. So that's something that grew out of the financial crisis.
Yeah, I guess the only other thing I'd add to that is, I guess similar at Goldman, same at Elgin, at Wellington, I think everyone has to go through compliance training and just training of awareness of everyone's responsibilities, and to just think about the client first. So it's really sort of been emphasized for people to make sure that ultimately everything being done is in the best interest of the client.
Yeah, absolutely. Yeah, I think that the three of you there have really kind of emphasized that the focus is about the client that you're working on behalf of, not an individual and for individual gain. And that certainly for financial services has been the message for, well, probably the last 10 years or so. That kind of post 2008, we need to be focused on the client, not on individualism and gains for those individuals. Very much so. I mean, even if we take into account the advisory space and things like the retail distribution review, taking away commission-based advice and that kind of thing there to stop people being advised incorrectly based on the level of commission that someone would receive. So there's been this trend to move towards the focus being about the client, and that's very much instilled in cultures of financial organisations like the ones that you work for. Thanks very much. It's nice goes back to ethics and integrity piece that we've spoken about at length, and doing the right thing, which is really, really important. So the days of people like Nick Leeson and Jordan Belfort, you would hope, are long behind us. So excellent. Okay, good stuff. Right, so that covers off investment banking. So what we need to also look at was the role of central banks, which are very different from investment banks, and also extremely different from retail banking. So again, there were some videos that I asked you to look at, and there were some questions to focus on for that. So what I've done here is we've got up on the screen some of the main activities of retail banks, comparing those with investment banks, as we've just spoken about, and then we have central banks here as well. So to recap, we've spoken about retail banks at length, about providing financial products and services to the general public and potentially to small businesses. So we're talking about loans, credit cards, personal borrowing and savings. And then with investment banks, we've spoken about the advice provided to corporates, whether that's private limited companies, PLCs, and about advising them about how they raise money to grow, or advising them around mergers, acquisitions, and growing through a strategic route that way. Now, central banks are very different again. So in terms of what central banks do, generally, they do a number of things, but some of them in different countries will do some things and they won't do others. Okay, so we're going to look in a little bit more detail about the Bank of England, specifically the central bank of the UK. But in terms of what central banks can do, and most countries have their own central banks. And if we've got the Bank of England here, in the US, it's the Federal Reserve or the Fed. You've got the European Central Bank, which looks after the Eurozone. So most countries have their own central banks. So the first thing they do is they can provide a protection scheme for savers or depositors. So that guards against people losing their savings if a bank were to go under, for example. Okay, so in this country, that's known as the Financial Services Compensation Scheme. Ironically, I've got it here, but ironically in the UK, the Bank of England doesn't actually look after that. That's that comes under the FCA's remit, or the regulator, the Financial Conduct Authority. But in other countries, it may do that. Central banks can often issue notes and coins. Again, in the UK, that's the Royal Mint. So we don't actually, that doesn't sit with the Bank of England, but it can sit with other central banks. Often acts as a banker to the banking system. Okay, so they can often act as the banker for other banks. Act as the banker for government. They can get involved with regulating domestic banking system, which again, we'll talk about the Bank of England's role in that. Often hold the nation's gold and money supply. And interestingly, with the Bank of England, they hold gold reserves in the vaults. And where the Bank of England is built in the City of London, the ground that it's built on, I can't remember if it's got clay or something underneath, which isn't particularly stable. And they can only hold certain amounts of gold on pallets. Otherwise, the gold starts to sink. The pallets start to sink into the ground. So there's some quite interesting, if you ever go to the Bank of England, there's some quite interesting stories they'll tell you about what some of the tales there, because obviously it's a very old building. So yeah, things like that. So holding the nation's gold supply is something they do. Influence the value of a nation's currency. Sets official short-term rate of interest, and we'll look at that in a bit more detail as well. Manages the national debt. So we're talking there about issuing bonds. So we've spoken about investment banks' role in advising companies about how they raise money through issuing bonds. In the UK, again, the Bank of England don't actually have responsibility of that. That's what's known as the Debt Management Office, or the DMO, that acts on behalf of the government to look at that. Could be that they control the money supply. And there we've got a couple of pictures on the left there of the Bank of England. And there on the right, we have the Federal Reserve in the US. So that gives you an idea that central banks perform more of a role around monetary policy, which we're going to talk about. And also there's more of a kind of regulatory role, acting as the banker to banks than the banker to government. So it's a much more centralized, as they're called, central banks. It has a much more central function, and kind of quite key to the regulation of the financial services landscape and the financial system. So central banks have a key role in making sure that the financial system is working effectively. And there's also this kind of economic role that they have to coincide with that as well. So we were going to, I mentioned monetary policy, and one of the things we spoke about in there was around setting of interest rates. So I'm going to test our panel here. What's the difference between monetary policy and fiscal policy? So what is monetary policy, and can you identify what it's like a test, isn't it? Can you identify the difference between that and fiscal policy from an economics perspective? Who wants to go?
I'll have a go.
Go on, Tutu.
So monetary policy is what you've just described, setting of interest rates and the amount of liquidity in the system, and fiscal policy is about the tax, right?
Right. Thank you. Excellent. Very good answer. Monica, anything you want to add to that?
I agree with everything Tutu just said.
Arnie,
I always get, to be quite honest, when I was taking economics, I always got the two mixed up. So it's not my strength. Yeah.
I think
what Tutu said.
Yeah. What Tutu said. Yeah, absolutely. No, you're absolutely right. Oh, the crux of it is that monetary policy is around controlling demand in the economy through the money supply. So you use interest rates as a mechanism to try and increase the level of economic activity or decrease it. And ultimately, that is the responsibility in the UK of the Bank of England. It didn't used to be. That changed in 1997. It used to be that the government, through the Chancellor of the Exchequer, through the Treasury, that used to be in charge of setting what's known as base rate or bank rate, which is the interest rate set by the Bank of England. So the use of interest rates to control, basically to control inflation, the increase in prices of goods and services over time, using interest rates is a mechanism of trying to control inflation. And obviously, as prices go up, things become more expensive. The economy if prices keep going up, you can have overactivity in the economy. And then obviously interest rates can be used to bring inflation down, but you don't want it too low. It's a balancing act for an economy to continue at a steady rate. And it was in 1997 when we had a Labour government in the UK where Tony Blair and Gordon Brown was the Chancellor of the Exchequer at the time. They transferred the ability to set the base rate of interest over to the Bank of England from it being centrally controlled by the government. So the idea was that there was a more independent opinion. And Gordon Brown spoke at the time of we're going to see the end of boom bust economics. So there was always we had periods where the economy would do brilliantly well, and the next thing is it would slump and plummet down into recession and a slump, and then we would spring out of it again. So the idea behind getting an independent Bank of England to actually take control of this was to try and keep the economy on an even keel, an independent opinion about how monetary policy should be applied and run. So monetary policy, we'll look at the Monetary Policy Committee of the Bank of England in a moment, but that in the UK is the responsibility of the central bank and has been since 1997. Fiscal policy, as Tutu, Monica and Arnie have all confirmed, is about taxation. So this isn't, and government spending. This isn't the responsibility of the central bank, not in the UK. The Bank of England don't look after this. This is a responsibility of government. So the raising of taxes and how those taxes are spent and how the government will spend that money and the projects that it's involved with and the services that it offers to the public, that's all in the hands of the government. So the Treasury determine, by the Chancellor of the Exchequer, they determine level of taxes through the HMRC. They collect them through Her Majesty's Revenue and Customs. So fiscal policy and monetary policy are combined together to try and create economic harmony, if you like, and balance off some of the negative impacts of economies overheating or economies becoming stagnant and going into recession and slumps. So it's a real balancing act here, and we'll talk about these in a bit more, especially monetary policy, in a bit more depth in a moment. So there were some questions that we asked based on the video. So again, I'm going to put these out to my panel. We've got a part of the Bank of England called the Monetary Policy Committee. What's their role? What's the role of the Monetary Policy Committee? Oh, I'm testing you, aren't I? This is
I would say it's to set the base rate, basically.
Right, excellent. And what sort of things do they take into account when they're setting the Bank of England base rate, or bank rate as we call it?
I would say that the Monetary Policy Committee and also we think about this from an asset management perspective as well, is thinking about the economics, so the larger macro pictures. So things like exchange rates, You mentioned, Matt, the inflation. That's a huge part of what they think about when they set about the base rates, and also just general growth. So when we think about sort of growth and unemployment rate and all of those kind of sort of macro picture things, it's what they think about.
Yeah, absolutely. So it's not just inflation that the Bank of England Monetary Policy Committee think about when setting the Bank of England base rate. You're absolutely right. It's a whole host of factors, but inflation kind of sits there as one of the main ones. And as you said, exchange rates, employment or unemployment, economic growth, GDP, all of these factors, as you said there, contribute to the committee making a decision about what they do with the Bank of England interest rate or the base rate there. Yeah, excellent. Thank you. Anything you want to add to that, Arnie?
No, I think it was all covered.
Yeah, okay, good stuff. So, do you know how often the Monetary Policy Committee meets?
Is it quarterly?
No.
Is it biannual?
You. No, it's monthly.
Oh
wow.
So every month they set the they look at these factors and then they set the base rate of interest. And actually, I think they met today or yesterday and decided to keep interest rates at the same level. I'm going to test you again. Anyone know what the rate of inflation was for December in the UK?
Is it
2%?
Is it 0.25? I thought 2%.
No. Up.
It's gone up.
Yeah, so it's in December it was 0.8% inflation in December. What's the current base rate of interest for the Bank of England as of the 4th of February 2021?
I would be guessing. I'm actually not sure.
No.
Oh,
Very low.
very low. Yeah, historically low. Yeah, it's
I don't know what the rate is.
0.1%
Yeah.
at the moment. The Bank of England base rate, so it's historically very, very low. So the Monetary Policy Committee has this overarching responsibility. It's a group of individuals at the Bank of England made up of the governor, who, if my memory serves me correctly, is Andrew Bailey at the moment. It was up until about a year or so ago, Paul Carney, who's the Canadian banker, and it's Andrew Bailey is now the current governor of the Bank of England. So a lot of responsibility sits on his shoulders. And ultimately, the Monetary Policy Committee meets monthly, and they look at these economic factors, as we've been speaking about, and decide whether or not to change the base rate or rate of interest of the Bank of England. Now, why is the base rate of interest important to the economy and potentially even financial services firms? What's any ideas from our panel? What's your thoughts on why the rate of interest is important? Why the base rate is important too?
It's the level at which companies can borrow money. And so if they want to grow their businesses and all of that, it's absolutely crucial to take that into account.
Yeah, absolutely. Yeah. Ultimately, it will be the kind of benchmark for how much it costs to borrow, and also how much people will gain in interest on savings generally, although banks kind of tend to set their own interest rates. They kind of use that as a guide. So yeah, it has a knock-on effect to other parts of the economy, and in terms of borrowing especially, that can have the base rate of interest can have a big impact on that. So if we have a low base rate of interest, the idea is to try and encourage the economy to grow. So if you've got low rates of interest, low base rate, low bank rate, what the idea is that you encourage people to go out and spend, because if you put your money in the bank, you're not going to get much of a return in terms of interest on your savings. So the idea is the lower the interest rate, the cheaper it is to borrow, and also conversely, saving your money isn't going to give you much of a return. So it tries to encourage people to go out and spend. So you will tend to see low base rates of interest when the economy is probably in a low patch, and they want economic activity to pick up. And we've had historically low rates of interest since 2008, since the financial crisis. So to give you some figures, in 2007, the base rate of interest was 5.5%. In 2008, in December, so following the financial crisis, base rate was cut to 2%. So it went from 5.5% to 2. In 2009, it then went down to 0.5%. In August 2016, that was lowered again to 0.25%, so it was halved. And then we now find ourselves in a position where we have the lowest base rate of interest in our history at 0.1%. And there's a debate around whether or not we will ever see the kind of interest rates that my parents would have seen when they purchased their house that were in double digits, or even the likes of the 5.5% that we saw in 2007 pre-financial crisis. There is a lot of debate around whether we will ever go back to a time where we have interest rates that are as high as that. Who knows? I mean, there's been talk a lot about interest rates going up, and then COVID hit. And then obviously the idea has been to keep those low because of the impact that that's had on the economy in the UK, but also globally. So the Monetary Policy Committee have a really important role to play. I'm going to kind of just look at this briefly in terms of giving a bit of history about the Bank of England. So it was founded in 1694. As we said, it's the banker to the government. In the late 18th century, it's the bankers to the banking system, and it does manage UK foreign exchange and the UK gold reserves. There are two things the Bank of England doesn't do from a central bank perspective, and we've already mentioned these. They don't manage the national debt. That's the Debt Management Office in the UK, so they're not in charge of the bond issues or anything like that. And they also don't provide a depositors protection scheme for savers if they have money with the bank. So if the bank goes under, it's not the Bank of England that put that scheme in place. And that scheme in the UK is known as the Financial Services Compensation Scheme. If my memory serves me correctly, savings are protected to the value of £85,000. I think I'm right. I don't think it's 80. I think it's 85,000. But if I'm wrong, please do correct me on that. So just kind of looking at what the Bank of England actually does. We've spoken about monetary policy. So obviously they don't have anything to do with fiscal policy and taxation and government spending. They are all about monitoring economic data and making sure that the economy via interest rates is under control and managed. So we said, the Monetary Policy Committee is the key organisation or part of the Bank of England on this front. And the Monetary Policy Committee is made up of the Governor of the Bank of England and a number of economists, and they look at all of the factors that, again, Monica spoke about, things like exchange rate, inflation, consumer borrowing, economic growth like GDP. They take all of those into consideration at their monthly meetings, and then they determine whether or not the base rate of interest from the Bank of England should be increased, stay the same, or lowered. Okay, so they make that decision. So there's a lot of power in the hands of this panel of individuals. This picture that we've got here is quite old because Paul Carney Mark Carney, sorry, the former Bank of England. Sorry, calling him Paul. Mark Carney, you can see in the middle there, is no longer there. And I can't remember if there's as you can see, it's not particularly diverse, the group of individuals, that they're all older white males. I do remember there being a lady on the Monetary Policy Committee at one point. It may even be now, but as you can see, it's not particularly a reflection of diversity there, is it? The Monetary Policy Committee, but that's their kind of key role that I had there. Now I'm going to test the group again. There's some stuff up on screen there. What's the key role of the Financial Policy Committee at the Bank of England? Any ideas?
I think after you two do, I think.
No, go.
If I remember correctly, I think it's focusing on addressing systemic risk, or just trying to make sure the that the financial market is like sort of more risk aware, essentially.
Yeah, absolutely, spot on. Yeah, thanks, Arnie. You're absolutely right. So the Financial Policy Committee at the Bank of England is a much more recently established committee. The Monetary Policy Committee has been around for a long time, but the Financial Policy Committee, this other group or board of individuals that sit there, this committee that they have, they very much, as Arnie said, it's about the financial system and looking at the risks associated with the financial system and trying to mitigate or control what's going on to prevent there being another financial meltdown. So ultimately, the Financial Policy Committee was put in place in 2011, and it was a response to the financial crisis in 2007 and 8. And ultimately, as Arnie said, it's about overseeing the stability of the UK financial system and taking actions where risk is seen as too high. And what you the Financial Policy Committee is one part of a bit of a regulatory overhaul for financial services after the financial crisis. So we had the Financial Services Authority, the FSA, and they were quite heavily criticised following the financial crisis for the role that they played and not doing enough. So action was taken to, if you like, compartmentalise the regulatory landscape. So we have two main kind of regulators that sit as part of the regulatory landscape, and we have the Financial Conduct Authority, or the FCA, as we've spoken about previously. And the FCA, really, a lot of what they do is around consumers of financial products and services, looking after, should we say, the public, and taking an interest in how they're treated and what firms are doing around those. And then the Prudential Regulatory Authority, or the PRA, tends to have more of an interest in big financial firms and what they are doing, and some of the activities that they are getting themselves involved with. And then what happens is they report into the Financial Policy Committee so that there is an overview of exactly what the financial landscape or the financial system looks like in the UK, so they can identify any potential issues that they might face further down the line as a result of what's going on with consumers, but also with some of the very big financial services firms that operate within the UK financial system. So their role is very much a regulatory role. It's kind of a policing role, has oversight, but it's also there to respond to that and take actions to try and mitigate or alleviate some of the risks that they potentially see as happening. I think hopefully I've summarised that up there. Anything that in your roles, do you come across? I take it you get quite involved with some of or have some contact with the regulators or individuals in your firms that are responsible for looking after that. Do you have much contact with them in your roles?
So from our point of view, one of the key things that we have to do to comply is to make sure we have enough reserves, I guess, to make sure that we can pay out the clients. We can give the clients their money back when they need it. So they'll get involved. For example, you know, in recent times when certain funds have when a lot of clients want their money out, you know, we have to make sure that we have enough reserves and enough processes in place to make sure that we can have enough cash available to pay clients when they want their money back. So that helps to maintain confidence in the system. So we won't. So, you know, hopefully we wouldn't get a situation like Northern Rock when clients lost confidence in a bank, and, you know, because a few clients had lost confidence, then it just snowballed and everyone wanted their money out because they were worried about getting their money out, and you just get what's called a run on the bank. So they try to make sure that all of the participants don't find themselves in that kind of situation.
Yeah, thanks, Tutu. Yeah, absolutely. Yeah, as you say, trying to prevent things like a run on a bank, as we saw with Northern Rock, and queues of people outside trying to withdraw their money. We've seen it in other countries as well, in places like Greece during the Euro crisis, people trying to withdraw money, and then capital controls being put on people so they can't withdraw certain amounts every day. So you end up with these issues, and as you say, it's kind of safeguarding against things like that happening and making sure that people are able to withdraw their money, that the firm has enough cash reserves sitting there to be able to do that. Thank you. Monica, Rani, do you come across regulators much, or is it in a similar way to Tutu?
Yeah, so I don't deal with them directly, but we certainly have to comply by the rules that they set, and as they evolve the rules as well. So, for example, treating clients fairly and making sure that we are that we are not selling overly risky products to a client who is not necessarily in a position to buy that product, for example. And also various other compliance factors, such as not sort of seen as bribing the client in any way, and making sure that, for example, if they're then working with the investment bank, that we are seen as very separate entities to the asset management side versus the banking side, because there's strict walls in between. So things like that, I think we just need to be extra compliant on, especially since the financial crisis.
Mm-hmm. Yeah, absolutely. Thanks, Monica. Rani, anything, do you come across them much?
No, just echoing sort of what Tutu and Monica said. I don't interact with them directly, but for instance, even at my time at Goldman, I know often with new regulations coming in place, a lot of institutions actually work with the regulator just to ensure understanding of what's being asked for, ensure compliance, so there's no grey areas. So I do know that there's definitely a lot of collaboration just to make sure, again, that ultimately rules are being followed as they should.
Great, thank you. Excellent, thank you all very much for that. It's just interesting to find out how much contact that people have with. I mean, obviously there are departments that within the firms that will deal with the regulator on a regular basis, but it's just interesting to know how much you in your roles might come across them. So to summarise, it's really about central banks. They have this kind of key in the UK with the Bank of England. There is this kind of economic role around a monetary policy committee, setting interest rates according to what's going on with the economic situation and the data that we're seeing in the UK. And then there's also this regulatory role where they look at the financial system and look at the risks that are associated with that. So we've got the Monetary Policy Committee that looks after the bank rate or the base rate of interest, which has an influence on interest charged to borrowers, and also has an economic role. And then we have the Financial Policy Committee that oversees the stability of the financial system in the UK, with what's known as the Prudential Regulatory Authority, or the PRA, and the FCA, the Financial Conduct Authority, reporting into them to give them that picture, so they can try and stop another financial problem as we saw in the 2007-2008 financial crisis. Okay, excellent. Well, that brings us almost to the end. The last thing, which I'm not going to go into a huge amount of detail that you don't need to know specifically for the level 2, but it's interesting to understand another role of the Bank of England, which is looking at the money supply. And one of the things that they have done a lot, and a lot of central banks have done a lot of over since the financial crisis, and the Bank of England is still doing this as a result of COVID as well. They do something called quantitative easing, which is a tool that they can use when interest rates are at a very low level, and they don't want to go below zero. So you can go into negative interest rate territory, which can cause some issues where you end up having to pay to save your money somewhere. So rather than you being paid to put your money with the bank, you have to pay them to store it. So you can get negative interest rates, which can have some issues. So quantitative easing is a tool that a central bank and the Bank of England have done this, a tool that they can use to try and stimulate the economy without trying to reduce interest rates to lower than 0%. So we're already, as we said, in the UK at 0.1%, but quantitative easing is one way to try and stop them having to introduce negative interest rates. So I'm not going to go into a huge amount of detail, but basically what this is when the Bank of England, they call it sometimes printing money, and that doesn't mean that the Bank of England just start printing cash and giving it out to people. What it actually means is they buy corporate bonds. So they buy bonds in banks and they buy bonds in companies with the idea that you give them capital, free up capital, especially for banks to be able to lend. So this was quite key during the credit crunch when banks weren't lending to each other. So the idea is you buy bonds, the Bank of England buy those. These companies will have to pay them back with interest, which is how bonds work, which we'll look at in the future. But the idea is it gives money, lends money to financial institutions and companies to enable them to carry on doing business, lending to others, and keep the economy ing rather than everything coming to a halt. So I'm not going to go into a huge amount of detail there, just to kind of, you can have a read of that slide. And there are some links, I believe, in the Google Classroom, which link to some information, further information about this. So that brings us to the end of the session. There is a quiz in the Google Classroom for you to do based on the content that we've looked at today. So please do complete that. So I'm just left to say this is the final time that we'll see Tutu, Monica and Arnie. So I just want to say a huge thank you to the three of you for participating in the last 3 or 4 sessions. It's been a pleasure to have you here. Really great for the students to hear from you as well. Some really valuable insight into what you do, but also the roles of different financial services organisations that we've looked at over the past 3 weeks. So really thank you. Thank the three of you very much for that. Really appreciate your support in there. And sorry for testing you in this one with some figures about inflation and interest rates. But yeah, there we go. But thank you so much. And we will see you next time for the start of the equities chapter.